Guys, when you talk about becoming an intelligent investor, it's important that you focus on the things that you actually control and you don't focus on the things that are out of your control, like the ebbs and flows of the stock market. What's happening in the outside world that's having an effect on the stock market? You can't control that. But there are certain human behaviors that you do have complete control over. And these are the behaviors that are going to sort of lead you to become more successful at investing. Now, the types of investments that are going to be popular over the next 20, 30, 50 years from now, who knows? We just don't know. Times change, trends change. But the kicker is this. Humans, we really don't change very much. The fundamentals of human behavior pretty much remain the same. So I want to talk about in this video 7 basic rules or principles of an intelligent investor that sort of goes against some of that human nature, but at the same time, it's going to help you not lose money when you're investing. Now, stay tuned for number 7 because number 7 is probably the most important one on this list. The very first quality of an intelligent investor that goes against human nature is just simply creating an investment plan of action, moving ahead. See, guys, you need a plan when you decide to invest. But that's not really human nature to sit down and write down every single thing that you're going to be investing in, why you're investing in it, how you plan to invest, all that good stuff. That's not really in human nature. Human nature says, jump on the bandwagon. Everybody's excited. Let's get excited too. Human nature is everybody starts running that direction. Let's run that direction too. But in order to be an intelligent investor, you have to go against that human nature and say, let me slow down and let me actually create a written investment plan to think this thing out, right? Because we know human nature is, hey, I see that piece of real estate. I fall in love with it. I get it. I see that stock or that company that's doing well. I fall in love with it. I go out and get it. That's human nature. And it's against human nature to avoid those trends or avoid that excitement or to slow down and be patient and actually create an investment plan for yourself. Now, your investment plan should at least include the following: how much time in years you plan to be investing, and before you need to actually start using the money that you're investing. It should also include the types of investments that you want to actually invest in, and your written investment plan on a spreadsheet or a piece of paper. It should mention how much you plan to invest, how often you plan to invest, and your investment beliefs and core values, because all those things are going to keep you in line when you're investing. They're going to help guide your investing decisions. And again, you don't want to create a plan that's paying too much attention to the past. That's human nature. You want an investment strategy and an investment plan that's looking in the future. Oftentimes, human nature makes us focus too heavily on what took place in the background a long time ago. But the intelligent investor says, okay, that's the past. I'm going to give it some weight, but not as much weight as my human nature would tell me to. Instead, I'm going to look at other factors moving ahead in order to be an intelligent investor. So I'm going to have forward thinking, sort of put some blinders on and not pay so much attention to what's in the rearview mirror, but I'm going to be looking forward as an investor. Remember, past performance matters, but don't make the human mistake of giving the past and these trendy impulses too much weight as an investor. So, do you have a written plan that's leading you and guiding you in your investment decisions? Let me know in the comments below, because the whole purpose is to not lose money. Let's go to number 2. Now, the second rule that's intelligent investing, but against human nature, is the superiority, the power of dollar cost averaging and committing to that over a long stretch of time. Human nature says, you know what? It's smart to buy low and sell high, or buy low and hold. Let me buy stocks or ETFs when they're low, and I'm going to hold on to all my money and just make sure that I only buy the dips. When things go down in value, I'm going to go buy. That's sort of our human nature, right? Because we're always looking for things that are cheap or on sale, right? Because we want to get them at a low price. But wisely, if you want to be an intelligent investor, you have to understand the concept and the potential for just dollar cost averaging, putting a specific amount of money towards a specific investment at regular intervals over a long stretch of time, right? Now, the flip side of that human nature that says it's on sale, let's go buy it, is the other piece of human nature that says, everybody's panicking. Let me get out and sell. And you end up selling low when you could have been dollar cost averaging in. You panic. And when you panic, you say, let me go, or everybody's hyped up. Everybody's excited. Let me go buy a stock. And the stock has already reached its peak and you end up buying high instead of buying low. And that's kind of the flip side of that piece of human nature. Part of us says, let's buy low and get a discount. But the other emotional side of us says, oh, it's a hot stock. Let me go buy it when it's high. So we have to watch that. And you can cover all that if you understand the power of just dollar cost averaging. There was a study that showed that if you missed the top 10 days in the stock market and you weren't in there investing because you were trying to jump in and jump out and buy the dips, if you missed those top 10 days over the course of 10 years, your portfolio could have lost almost half of its value just by missing the top 10 days in a 10-year period. So it's really important, guys, that you understand that intelligent investing is not jumping in and jumping out and trying to time the market and buy the dips. And intelligent investing goes against all of those different human behaviors where we try to time the market and buy it low, or we emotionally end up buying it high. Dollar cost averaging does away with all that because it means you're in the market when the market's going up. You're in the market when it has those 10 highest days over a 10-year period. You're in the market on the way down. You're just in the market all the time. It's not about timing the market. It's about time in the market. Patient investors see larger profits by simply allowing their investments time to grow and not jumping in and out. Dollar cost averaging allows you the benefits and the positive effects of compounding without the stress, without the anxiety, without the guesswork, and without any of the excitement. You just get better results when you dollar cost average in. Guys, if you get value from this video, please smash the like button below. And please consider subscribing to this channel if you're not already a subscriber. And also, don't forget to share this video with your friends and your family. Now, let's go to number 3. The third rule of intelligent investing that goes against your human nature is to simply only invest in things that you fully understand. Sometimes we think we know an industry and we don't. Sometimes we think we know a market and we don't. But knowing exactly what you're investing in helps you make better investing decisions. In other words, if you don't understand a product, or you don't understand a market, or you don't understand a particular industry or business, you got two options. Either 1, learn about it first before you put your money in it, or 2, don't invest in it. Go the other direction into something that you feel comfortable with. Because what it does, guys, is it reduces your risk. When you've done your research, you understand what you're investing in. But oftentimes, human nature, we see something we like, we think we like it, we feel like we like it, and we go invest in it. That's the wrong way to invest. If you want to be an intelligent investor, you don't make guesses and you really don't speculate. You do your research. You understand where you're putting your money, because the level to which you understand the company, the industry, the market is the level at which you will lower your risk. In other words, the less you know, the more risk you're taking on. So know what you're investing in and know it well. Now, number 4 is risk what you can afford to lose. Intelligent investing is taking well-researched and well-informed, managed, mitigated risk. Risking only what you can afford to lose in terms of money lowers your overall risk, lowers your overall stress, your overall anxiety, right? There's some people that want to get out there and spend money and take a shot, but there's a lot of people who want to not take any risk at all and avoid all risk to any extent. They want to take their money and go hide it under a mattress. But the problem with that is, by trying to avoid risk, you're actually creating more risk. So I'm saying go against the human nature to hoard. And here's how you go against it. Spend what you can afford to lose. Benjamin Graham, in his book, The Intelligent Investor, said successful investing is about managing risk, not trying to avoid risk. So it's important to know your own risk tolerance level, which is how much risk you're willing to take, because this is going to increase your chances of being successful in the long run. Just keep in mind that all investments come with risk. You can't avoid it. So one way to mitigate it is by doing the things I'm talking about in this video, including making sure you only invest what you can afford to lose. Now, one of the most critical ways that you can manage risk is number 5. Number 5 is diversification. In order to be an intelligent investor, you have to Spread your risk around. Human nature says, I see something, I go all in on it. I really enjoy this stock, I'm throwing all my money at that stock. I really enjoy this particular industry, I'm throwing all my money in the healthcare industry or in the energy industry, right? That's human nature. But to go against human nature is to say, slow down, wait a minute, let's diversify and make sure we don't have all of our eggs in one basket. And so that means diversifying your investments into different sectors, into different markets, into different assets, into different investment types. When you do that, you automatically mitigate or reduce your risk that you're exposed to. Now, number 6 is reinvest dividends. Human nature is to receive all the money coming to us and get it right now as soon as it's ready to come to us, right? Human nature is that stock pays dividends. I want my dividends. Give me my money. That's human nature. However, I always suggest that you consider strongly reinvesting your dividends. Dividend reinvestment is when you decide to reinvest the dividends that you've received from an investment. A stock will pay a cash dividend to its shareholders. Instead of taking that cash dividend in the form of a check for $20 or $30 or $100, you take that and you automatically reinvest it back into the stock. And you might say, well, why do you reinvest? Well, here's why, guys. 2 reasons. One, the money just compounds and you end up at the end of 10, 15, 30 years, you have a whole bunch more money because you put the money right back in. But the second reason I suggest you reinvest your dividends is because if you're investing money that you can afford to lose, it means you're getting back dividends that you can afford to live without. So you might as well put the money right back in. And you can use this strategy to buy more shares and ultimately really increase your earnings over the course of time due to compounding. Now, I asked you to stick around for number 7 because number 7 might be the most important of all of these things that you have to do to be an intelligent investor and go against your human nature. And that is, don't panic. It's human nature to panic. It's human nature to become stressed and anxious and worried and concerned and angry. But I'm saying, don't panic. It goes against human nature to chill, sit back, relax when everybody else is panicking. Relax when everybody else is going crazy or overly excited. Because we all know panic sets in when the stock market dips and goes down. And oftentimes what happens to a lot of people is when they start to panic, they start to make bad decisions with money, bad decisions with investments, and bringing in emotions to investing. The biggest key to becoming an intelligent investor is to be patient. Don't panic. Just keep dollar cost averaging, whether the stock market is way up or whether the stock market is way down. You don't have to stock watch, right? You don't have to chart watch and see what's happening every day on your stocks. You do not have to do that to be an intelligent investor. That makes people emotional. That makes people get upset. That makes people overly happy, overly sad. All these things kick in, these different emotions when you invest like that. Now, let me give you a few solutions. How do you avoid panicking? First, tune out all of the financial news, the social media, the buzz that's going around. All of that could be irrational exuberance, right? People getting hyped up and excited over something. You have to tune that out. Another thing you can do is always do your due diligence. The more you research and learn and understand what you're investing in, why you're investing in it, the more you understand those things, the more calm you'll be. And also remember, markets bounce back. They don't go down and stay down, right? Bear markets are shorter than bull markets. And you have to make sure you avoid mixing in emotions with investing. Emotions with money. Never a good thing because it causes you to make bad decisions. And you want to be sure that you're investing for the long term. And over the course of the long term, we see little chinks where the market goes down, but then we see it go back up higher. We see it chink down again and we see it go higher. And over time, the market goes up. But your job to make sure you don't panic is that you understand that dips in the market represents opportunities for you to be buying investments at a discount, to be buying investments for cheap. You got to see market crashes and these dips as opportunities. That's being an intelligent investor. Listen, whether it's the stock market, real estate, commodities, gold, silver, doesn't matter what it is. You've got to consider strongly going against some of your human behavior. And that really is what makes investing such a difficult science for most people to master. Remember, create an investment plan. a written investment plan. Commit to consistency over a long stretch of time through dollar cost averaging. Only invest in the things that you fully understand. And if you want to invest in something, be sure you learn it first and risk only what you can afford to lose, and diversify your investments. Spread it around, reinvest your dividends, and most of all, do not panic. Bottom line, don't lose money. Hey, if you got value from this video, do me a favor, share this information with your network of people, hit that like button for me, and remember, the best person who's going to take care of the old you is the young you. Take good care of yourself and take care of other people. Until the next video, peace.